The medieval peasant paid 30% of everything he produced to a lord who owned the land. You pay 30% of your income to a landlord who owns the building. The peasant couldn't leave without permission. You can leave. You just can't afford to go anywhere the jobs are. We didn't end feudalism. We made it optional looking. Welcome to Economic Historian, where money reveals what history hides. Here's the question that should keep you up at night. How do you build an economy where people work harder than any generation in history, produce more total wealth than any civilization before them, and still end up owning less than their parents? You don't do it through poverty. Poverty is visible. Visible things get revolted against. You do it by creating a system that looks like ownership while functioning like tenancy. You give people just enough participation to feel like players while engineering the rules so they never accumulate enough to change their position. The medieval peasant knew exactly what he was. That was the system's weakness. The modern version fixes that flaw. The modern tenant thinks he's temporarily broke, not structurally locked out. That's not a side effect. That's the design too. Understand how we got here. You have to understand what feudalism actually was. Not the fairy tale with knights and stone keeps, but the financial machine underneath. Feudalism wasn't a political system. It was a cash flow system with swords as the enforcement mechanism. The logic was this: land was the only productive asset that mattered. Control land, and you controlled food, shelter, labor, and survival. The Lord didn't need to threaten anyone directly. He just needed to own the one thing nobody could live without, then charge for access to it. By 1086, William the Conqueror commissioned the Domesday Book, the first comprehensive property survey in English history. The results were stark. Roughly 200 Norman barons controlled nearly all productive land in England. The remaining 1.5 million people worked it in exchange for the right to stay alive on it. They kept enough to continue working. Everything above that threshold flowed upward. The mechanism that made this permanent was simple. Serfs could never accumulate enough surplus to buy land of their own. Their labor produced just enough to keep laboring. The extraction rate was calibrated, not so high it triggered revolt, but high enough to prevent exit. The difference between oppression and feudalism is that feudalism is sustainable. The Church called this the Great Chain of Being. God arranged the hierarchy. Questioning your station wasn't political dissent, it was heresy. Every extraction system needs a theology to survive. Keep that thought. The Black Death broke the model. Between 1347 and 1351, 1/3 of Europe died. Suddenly, labor was scarce. Peasants could negotiate. Some accumulated capital. By the 17th century, enclosure laws in England had converted communal farmland to private property. Another wave of closed displacement, but the principle had shifted. Property could now be owned by merchants, traders, commoners. A middle class was assembling itself. By the 20th century, the arc looked complete. Mass homeownership, pension funds, rising wages. The gap between asset owners and everyone else compressed to its narrowest point in centuries. In 1960, the U.S. homeownership rate was 62%. It would peak at 69% in 2004. For one unusual window in history, ordinary people owned things. That window didn't gradually close to a shut between 1970 and 2023. U.S. home prices adjusted for inflation rose 220%. Real median wages over the same period rose 15%. The primary wealth-building asset available to ordinary people got 15 times more. Expensive relative to the income required to buy it. This isn't a supply story, though supply is constrained. It's a capture story. Since 2010, institutional investors have purchased over 500,000 single-family homes in the United States. In Atlanta, institutional buyers accounted for an estimated 30% of home purchases in specific quarters. During 2021 and 2022, Invitation Homes holds over 80,000 properties. Blackstone's residential portfolio spans tens of thousands more. These companies did not buy homes to live in them. They bought homes to collect rent from people who can no longer afford to buy. The feudal lord owned the land and charged peasants to work it. The modern version owns the housing stock and charges workers to sleep near their jobs. The vocabulary changed. The cash flow didn't. But housing is only what you can see. The deeper capture is happening somewhere most people never think to look. In 1970, the wealthiest 1% of Americans owned 30% of all financial assets, stocks, bonds, business equity. By 2023, that figure crossed 50%. The bottom 50% of Americans, minus 165 million people, own 1% of financial assets combined. The mechanism isn't theft. It doesn't need to be. Capital earns returns. Returns buy more capital. That capital earns more returns. The gap between people who own productive assets and people who sell labor to those assets widens. Automatically, no malice required, no conspiracy necessary. The system just needs time. And once concentration crosses a certain threshold, self-correction becomes structurally impossible. The people who would fund the correction don't have the capital to do it. The medieval theologian called this providence. The modern economist calls it returns to capital. A person working 2 jobs and still renting calls it something else entirely. Now here's the layer that would have made a 14th century lord genuinely jealous. Medieval feudalism required physical land. What happens when the productive infrastructure isn't physical anymore? Amazon takes 45 cents of every dollar that third-party sellers earn on its platform, a cut that has roughly doubled since 2014. The seller owns the inventory, handles the shipping, absorbs the returns, and builds the brand. Amazon owns the route to the customer. Uber takes 25 to 30% of every fare. The driver owns the car, pays for insurance, absorbs depreciation and maintenance. Uber owns the dispatch system, the modern equivalent of the road itself. You can participate. You are actively encouraged to participate, but you will never own the infrastructure. You rent access to the marketplace, and the rent goes up whenever the platform decides it should. The Venetian Republic understood this model in 1300. Venice didn't manufacture the goods that made it rich. It controlled the Mediterranean trade routes. You could ship whatever you wanted, spices, silk, glass, but you shipped it through Venice, and Venice charged accordingly. The Venetians called it commerce. Bezos calls it platform fees. The architecture is identical. Own the passage, tax the traffic, never touch the goods. Strip away the app design, and you have the same structure that's been extracting value for 7 centuries. A small number of entities controlling the infrastructure through which everyone else must pass, collecting rent at every step, on every transaction, forever. This machine didn't survive unchanged from medieval Europe. It was suppressed by labor organizing, antitrust law, progressive taxation, and the specific post-war conditions that briefly made mass ownership possible. Those suppressors have been systematically removed since 1980. Capital gains tax rates fell, while income tax rates restructured to favor asset holders. Antitrust enforcement contracted so dramatically that industries which would have been broken up in 1965 now operate as unchallenged monopolies. Labor's share of GDP, which tracked productivity growth for decades, decoupled sharply, starting in the 1970s, and has been falling since. New business formation, the mechanism by which people exit wage labor into ownership, dropped 44% between 1978 and 2012. None of these changes individually looks like a system being engineered. Each one looks like a policy choice, a regulatory decision, a market outcome. Together, they form something with a recognizable shape. Every mechanism that allowed people to convert labor into assets was weakened at the same time. Every mechanism that allowed existing assets to compound faster was strengthened. The medieval serf couldn't accumulate enough to buy land. The modern version can't save enough to buy a home in the city where the work is, can't build a business on a platform that rewrites its terms unilaterally, and can't outrun the returns accumulating to those who got there first. Different century. Same gap, same function, same result. Medieval feudalism justified itself with God. You were born into your station because the divine order required it. Questioning your position wasn't an economic argument. 'Twas blasphemy. The modern system has a better theology, meritocracy. If you own assets, you earned them. If you don't, the market has simply reflected your output accurately. The structure, the entry prices, the compound returns, the platform fees. The rules of accumulation is neutral. Natural, just the market finding its equilibrium. Theologies are always most convincing to the people they serve. This is what neo-feudalism actually reveals, not that powerful people are uniquely corrupt, but that a system where productive assets concentrate without limit, where entry costs rise faster than the income to meet them, and where participation requires renting infrastructure you will never own, is not a market correcting toward efficiency. It's a market correcting toward the shape all unregulated markets have always corrected toward. We've seen this shape before. We know exactly what it looks like from the bottom. History doesn't repeat, but the incentive structure does. And once you see the incentives, the outcomes aren't surprising anymore. They're predictable, which means they're also visible if you know what to look for. If this opened your eyes, subscribe now. The economy has a memory, and I'll help you understand it.